Hello out there in cyber accounting land. Professor Ebit here to help you master it quick. In this session, we'll look at inventory and retail accounting. First, we'll concentrate on retail accounting, and the nature of retail business is different from a service business. The service businesses were selling work, of course, auto repair work, paint shop work, what have you. Retailers make their money by buying merchandise from wholesalers for as low a cost as they can and selling it to customers like us for the best price that they can as many times as they can. As we work with this, you'll see the speed with which they sell is very, very important. The more times they sell, the more times they'll make the markup on the goods. Now, what the markup really is we'll talk about what these adjustments are up here in a minute. The net sales minus how much the merchandise costed the store gives us a number that's referred to as gross profit. What it really is markup on the goods. If our store bought shirts for $10 and sold them for $20 each, we'd have a $10 markup on each shirt that we sold. So the more shirts we sell, the faster we do it, the more gross profit we'll generate, which is good because it has to pay for everything else. And the faster we'll turn the inventory into cash, which is very, very important. When retailers make an income statement, it looks different from the income statement for a service company. Here's an example. We're steamrolling over income taxes, which is okay for the purposes of this introduction, so we'll view net income as gross profit less selling and operating expenses. As you saw from the slide, the multi-step income statement still shows how much profit or loss there was, but it also provides a little bit of additional information which will help the retail company operate their business better. Let's look at these two adjustments up top for a second. Sales is the retail company's version of revenue. Instead of earning it by doing work like a service company did, a retail company earns it by selling merchandise or products to customers like us. There are two adjustments that are made to the sales figure to get what is referred to as net sales. One of them is purposely done on our part, that's sales discounts. And the second one is called sales returns and allowances, which might be because somebody messed up someplace. First is sales discounts. At the retail level, like when we go into a store, you would probably not see this done very much. The price is already reflecting a discounted amount or there's a coupon being used. This would be seen at the business-to-business level. If one wholesaler sells to the next wholesaler in the chain, they're selling a very, very large amount of product. It could be $20, $30, $40, even $100,000. So what they will do is they will offer an amount off the bill for paying within a shorter period of time. Standard credit terms are probably 30 days or so. A discount means that you're offering the customer money off if they pay you in 10 days instead of 30. So the adjustment that would result from the discounts is us offering our customer, which might be another wholesaler, an inducement to pay quicker. The reason why we do this is to get the cash in sooner so that we've got cash to be able to take a discount that might be being offered to us. The second adjustment, returns and allowances, I'm abbreviating it R&A here, is probably because something went wrong. Sales returns means a customer's bringing something back to our shop. Okay, we're not satisfied with it for some reason. So the more of that happens, the worse it is for us. So that's why we split it out so that we can monitor how often that is occurring. A sales allowance is a little bit different. What that means is we're reducing the customer's price because we fouled up. We were late with the merchandise or it got scratched on the way over, what have you. So in an allowance, they are not bringing something back. In a return, they are. So when a sales return happens, we have to put the item back into the inventory so that we can sell it to somebody else. In this type of income statement, the multi-step type, there are two pieces of information that are more readily available for us, the retail managers, to use. One of them is the gross profit rate. The gross profit rate is computed by taking the amount of the gross profit and then dividing it by the amount of the net sales. So in other words, it's the gross profit as a percentage of the net sales. This will let us see if we're making the amount of markup that we expected to make. If it falls short, there are two possible causes. One, we may be losing a lot to sales returns, more than we expected to, which is going to shrink the net sales down. Or the merchandise might be costing us more to buy at the wholesale level than we expected, both of which are things we'd be interested in taking corrective action on. The second thing that is made more easily available to us with a multi-step income statement is the profit margin, which is sometimes called return on sales. That's computed by taking the net income and dividing it by the net sales. So how we could tell that this company held on to a little bit more than 18 cents worth of profit out of every sales dollar is by computing the profit margin for them. The net income was $15,000 divided by the net sales of $80,000. So in that period of time, the company kept almost 19 cents of a net sales dollar as profit. Now suppose Jim's Menswear wanted to increase their profits by $1,000. How much more would they have to sell to be able to do it? Well, from the income statement we can see that the net income was $15,000 and the net sales was $80,000. So when we computed the profit margin, we saw it was 0.1875. So a little algebra will help us see 0.1875 is equal to $1,000 divided by the net sales that we need. We would actually need to sell about $5,330 worth of extra merchandise. Now that's a lot of work. The reason is because we have to sell the merchandise and then pay for the merchandise cost and generate the gross profit from the sale. And then we have to incur these expenses down here at the rate we had been incurring them in order to walk away with our $1,000. Quite a bit of work. You know how else gyms could do it without lifting a finger of sales? Cut $1,000 out down here. These expenses are sometimes called below the line expenses, and by that they mean they're below the gross profit line. If we could cut $1,000 off of those expenses someplace, it would drop directly down to the net income and give us our extra $1,000. So again, the multi-step statement lets the retail company monitor how much they're spending for selling expenses, operating expenses, to see if there's anywhere where they might be able to economize. If you've ever operated a store, you'll know what I'm talking about. Journal entries for a retail company are a little bit different, which is why I wanted to take a few minutes and go through with you how the journal entries would be made when the store buys inventory, and then if they have to send some of it back, and then how do they handle paying for it if they were offered a discount from the wholesaler. First, up top I have perpetual inventory listed. There are two major inventory systems, perpetual and periodic. When we do the inventory costing session, we'll get into the details a little bit further. But in a perpetual system, there are fewer accounts used, which is why I use it to illustrate this. In a perpetual system, when the store buys inventory, all they're doing is they're buying an asset. So inventory, as you know, is a current asset. So when I increase it, I'll use a debit entry. So this will be whatever we paid for it. And then the credit will go to accounts payable. So it's like buying an asset on account or on credit when we buy inventory. Now it hasn't been sold yet, which is why it's still in the inventory account. If we have to send some of it back because it's the wrong kind, what have you, wrong size, wrong colors, whatever, that is sometimes called a merchandise return. In the perpetual system, a merchandise return is very easily done. It's simply the reverse of a buy. So to the extent that we send stuff back, if we bought 10,000 up here and sent $1,000 back, we would do this entry here for $1,000. The debit would reduce accounts payable. We owe the vendor less because we sent some of the stuff back. And the other side is reducing our inventory account because we don't have it anymore. Now, when it comes time to pay, if the vendor did not offer us a discount, we would simply pay them at the end of the credit period, 30 days later, whatever it might be. But they might have given us an inducement to pay sooner. And if they did, we would want to see, number one, did something reduce the amount we originally owed them? In other words, was there a return? Now, in this case, there was. So we'd take the amount up here and reduce it first by the amount of the return, and now we're working with the amount reduced. And then secondly, we'd want to see when did we buy this merchandise and when did the discount period begin? If we bought it on the first of the month and the vendor offered us 2-10 terms, that means they're giving us 10% off if we pay, 2%, I meant to say if we pay within 10 days. If that's the case, we have 10 days to write our check out and send it. So if we do it, we take the 2% reduction, which will reduce the inventory cost, and we only got to pay them 98% of what we owe them. So the debit to accounts payable is the amount we still owe them. Then a credit to cash for 98% of that if we pay soon enough, and the 2% reduction reduces the inventory cost. If we fail to meet the 10 days, then we're too late to take the discount, so the whole thing is done at the net amount, just like paying any other type of a bill. Now, what's characteristic of perpetual inventory is the sale and the cost of goods sold are recorded at the same time. Picture when we go in the store and bring things up and scan them, either at the self-checkout line or the cashier does it for us at the checkout line. What you and I see is the top piece, the sale being rung up. Now, in our case, of course, it's a cash sale, but if it were to another company, we would be giving them a bill, which is why it's accounts receivable, and then the credit side would go to sales. If it's a perpetual system, at the same time, we want to take what the merchandise cost us and send it into cost of goods sold. That's what the debit side of this entry is doing. Remember, cost of goods sold is a type of an expense account. Now, I know it doesn't say expense on it, but it behaves as an expense account does. When you debit it, you're increasing it. If you credit it, you're reducing it down. So if this merchandise sold for $16,000, we would debit accounts receivable $16,000, credit sales for the same amount. If the cost was $8,000, we would be using $8,000 for this entry down here. So in other words, we've made gross profit from that sale, the difference between the selling price and what it cost us. So in a perpetual system, they're done at the same time, like the scanner would do. The part that we don't see the scanner doing is the scanner's taking the cost of the item that we bought out of inventory and putting it into cost of goods sold. So you might say, well, how's a scanner know how much it is? It's done with barcode technology. When the store buys the inventory, they scan it in, the barcode, and the system knows, okay, here comes 100 boxes of cereal. They cost this much each. So when you and I go buy a box of cereal at the supermarket's going to debit cash and then credit sales when we ring up the sale. And then the scanner is also grabbing the cost of the cereal out of inventory and putting it in cost of goods sold. They happen at the same time. Periodic system is different, which we'll see when we do inventory costing, but perpetual, they both happen at the same time. In the perpetual inventory system, this is how we would account for a customer bringing merchandise back to our shop. In other words, a sales return. If the customer brings back or sends back because it was a wrong sizes, what have you, we're going to make use of one of those accounts that you saw being used on the multi-step statement, sales returns and allowances. Notice we are debiting the account. That is because that is a contra account. It's contra to sales. When we increase sales, we use the credit entry. It's a revenue type account. This guy, we put a debit in there. In other words, it's a reduction of sales. So that's true to form. On the top of the multi-step statement, we were minusing it out from sales to get net sales. So this will be for whatever the selling price of the stuff was that the customer sent back. All right, so now we got the merchandise back. We have to put it back into the inventory. So that's what the second piece of the entry is doing. So we're going to debit inventory for what our cost was, not what the selling price was. We're going to put the merchandise back into the inventory and then reduce cost of goods sold. So if this stuff had a selling price of $2,000, we'd be using that for this entry up here. And if the cost to us was $1,000, we'd be using the cost down here to put it back in. So you can think of this bottom piece as the reverse of the entry when it comes out of inventory. The item is simply going back in. Now in another session, we'll look at internal control issues. This brings up the possibility of a theft. You have to make sure that that stuff being brought back actually gets into the inventory, which is why your internal control system has to be set up so that it'll monitor that. So it might need the manager to approve it or some way of stopping the employee from simply keeping the merchandise and selling it themselves, which they might be able to do if it was Eagles jackets or something like that. In the perpetual system, when a customer pays our bill to them and we had offered them a discount, here's how the entry would appear. We're debiting cash, of course, because we're receiving money. The amount of the money that we receive is going to be reduced by the discount that we offered to the customer if they paid us soon enough to be able to earn it. If they did, the discount amount will go as a debit into the sales discounts account. Now, once again, you see this account being used with a debit, like sales returns and allowances. It means it's contra to sales. So on the top of the multi-step income statement, we took sales and we minused out sales discounts. It's because it has a debit balance in it. Now, this is only if they paid soon enough to get the discount that we offered to them. So if we offered them 3% 10 days, and our date of our invoice was the 2nd of the month, they'd have to pay us on or before the 12th of the month to be able to get this. If they did, 3% off the bill would go there. 97% of the bill is what we would collect in cash. And then the entire bill is a reduction to accounts receivable, just like when you collect an AR in a service company. So these discounts, as we mentioned, are more often seen in the distribution channel, from the manufacturer to the first wholesaler, from the first wholesaler to the second one who might be moving it to another part of the country. There might be another wholesaler in the channel that's moving it to the store where you and I go in and buy it. So we're not going to see 210 net 30 when we go in the store, but people in the distribution channel, it's very often seen. If our company was using a periodic system instead of a perpetual one, these entries would be a little different, as you'll see in this slide. In the July 1st entry, we would be debiting the purchases account when we buy the inventory rather than the inventory account. The freight to get it would go to a freight in account rather than the inventory account. The July 2nd entry, when we sent the merchandise back to the supplier, we would be crediting a purchase returns account instead of the inventory account. In the July 3rd entry, you wouldn't have a cost of goods sold entry at the same time as the sale, because in a periodic system, it's all done at the end of the period. Your July 5th entry would also just have the top part of it. July 10th entry, when we paid the supplier and got a discount, instead of crediting the inventory account, we would credit purchase discounts if it was a periodic system in use. And the July 13th entry would be just the same. Even in the perpetual system, the retail company has to do this calculation at least one time a year to be able to verify the amount of cost of goods sold that the system has been collecting during the year. If we have a periodic system, we have to do it every time we want to find out how much the cost of goods sold is. Basically, it works like this. We'll take whatever inventory was unsold at the beginning of the period, in other words, left from the previous period. That's a top number. Then we add to it a figure that's called net purchases. This is all the inventory we bought during the period plus the freight to get it to our place. Adjusted downwards for two things. If we had a discount for paying the supplier's bill soon enough, it shrinks the cost, so that's subtracted out. The other thing that's subtracted out is if we sent anything back to the wholesaler because it was a wrong size or wrong color or what have you. So purchases plus freight minus discounts minus returns is net purchases. So it adds on. It's that much more inventory that's available to be sold in the store. So that's what this figure is here. Cost of goods available for sale is everything in the whole store that was there during the period and could have been bought by a customer. What we do next, go take the physical count at the end, how much is actually still left. We subtract that away from what was available to sell, and then we back into the amount that came out. Now remember, this is mostly merchandise that was sold, but it will also include the cost of any merchandise that was damaged and it can't be sold, because the sending count here is only good saleable inventory. So if something was broken, like if it was a box of dishes and I dropped them and I can't sell them now, it's going to drop down into the cost of goods sold. Also the cost of any stolen items. If somebody steals items out of the store, that cost is going to drop down to there, and think about what that does. That cost of goods sold number is going to be used on the multi-step income statement, and it's going to shrink the gross profit. I got a cost going in there for a jacket that somebody stole, but I don't have a sale offsetting it at the top. So the store's gross profit is shrunk. So shoplifting, I should say, is very, very detrimental to the store. That's why they go to a lot of trouble to try to prevent it. So now you've had an overview of inventory costing and how the different methods work, and hopefully this has improved your chances of getting a good score on your next exam, which is what we're trying to do. This is Professor Ebit checking out. I'll see you next time.